Okay, here we'll be looking at testing for goodwill impairment. Our example will be for a business acquisition where Corporation A buys Corporation B and goodwill is established in the acquisition of Corporation B. First, we'll calculate the goodwill in this acquisition based on the fair value of the net assets acquired from Corporation B, then look at testing of the goodwill to see if the price paid by Corporation A for Corporation B was reasonable, and then finally look at goodwill testing for later periods. Our impairment testing will be for estimating the present value of future operating cash flows generated by this acquisition, then comparing these cash flows with the carrying value of the net assets acquired to determine if there is any goodwill impairment or loss on this acquisition. Okay, starting with our example here for goodwill impairment testing based on the recent purchase here of Corporation B by Corporation A. So looking at the balance sheet here for Corporation B, the first thing we have to do is determine the fair value of the assets and liabilities that are being received here by Corporation A. So I've done that here. And the total assets here at their fair value is $920,000, and the total liabilities here at their fair value is $160,000. So the next thing we have to do is do a value analysis here. Now Corporation A here has purchased the net assets at their fair value, and they've exchanged their common stock for these net assets here. And the value of the common stock that they exchanged in this case was $860,000 worth of common stock. So they issued this common stock to Corporation B. So then we have to determine the fair value of our net assets here. And that was the $920,000 worth of the total assets less the fair value of the total liabilities, $160,000. So the fair value of the net assets was $760,000 worth. Next thing we have to determine is the goodwill involved in this acquisition. So we look at the price that was paid here by Corporation A here was $860,000. That was the stock value of the stock that they issued. And then we look at the fair value of the net assets received here by Corporation A. That was $760,000 worth. So looking at the difference between the price paid here of $860,000 and the fair value of the net assets received of $760,000, we have goodwill here of $100,000. So Corporation A only received $760,000 worth of fair value here for these net assets, but they had to pay $860,000 for them. So this is where the goodwill is involved, and that was $100,000 here. And that goodwill here is shown on the balance sheet here for $100,000. Okay, next we have to determine the net present value of the future operating cash flows net of tax generated by this acquisition. These are the cash flows based on the future sales and both the operating and capital expenditures required to support those sales. So what I've shown here, we're going to have cash outflows, there's investments that we're going to make in the next 10 years here that I've got projected, and then we're going to have cash inflows based on the what this acquisition here can generate. And the cash inflows here are based on a 10% growth rate per year for the next 10 years. And then what we do is we take the net cash flow here between the cash outflows and the cash inflows, and then we discount that net cash flow back to the beginning of our calculation here, in this case, or the beginning of the year zero in this case. And what these really represent here, for example, we make a investment in a machine here, a cash outflow of $25,000. And then in the future here, this machine is going to generate us cash here. So we take the cash outflow and net it against here the cash that it's going to generate to us, and we come up with a cash flow. And say, for example, a cash flow here was $85,000 here for year one. We discount that back to the year zero here, and it would be worth $78,000. So when we sum all of our net cash flows here and discount it back at, in this case it was a discount rate of 8%. That was what we required here on this investment. They have to generate 8% 8% return here for our investment. So when we discount that back here at 8%, we get a net present value of approximately $942,000 for this acquisition. Now that would be its fair value here, discounted back to the time period that we're looking at, and that's $942,000. Okay, now we can do our goodwill impairment testing. Now the estimated fair value of the acquisition here based on the discounted future cash flows here was $942,000, and the price we paid here was $860,000. So we paid less here than the estimated future value here of this acquisition. So we have excess fair value here, and that indicates that we have sufficient goodwill here. Now this indicates also that the price paid here was reasonable. Now if the price paid here represents the future value of the assets plus the goodwill is greater than the estimated fair value here that we calculated, then we have to reassess our model here and go back and redo our calculations. And if the price paid here is still greater than the estimated fair value here, then there's likely an impairment loss here to goodwill. Okay, now to determine goodwill impairment testing for later periods. That would be the annual test. So looking at our cash flows here, we'd have to determine the net present value of the future operating cash flows, just like we've done before, but we'd have to base these cash flows based on the impairment test date here, or the period being tested. So again, I've forecasted here the cash outflows and the cash inflows, and I used a growth rate of 9% per year in this case, and then I discounted these net cash flows back here using the discount rate of 8%, or that's the required rate of return here of 8%, and then I come up with a net present value here of $886,000. Now that would be the fair value of this business unit that's being tested. Okay, now looking at our balance sheet. We have to determine the fair value of the assets and liabilities here by factoring in their carrying value for these net assets. That's for the period that's being tested here. Now this fair value here is used to measure the impairment loss, but it's not recorded. We maintain our books based on the carrying value of the assets and liabilities. The fair value here that we're determining is only for the impairment test. So our fair value of our net assets in this case, $950,000 in assets minus $130,000 in liabilities, we get a fair value of net assets here for $820,000. Now looking at the net amount here, our fair value of $820,000 plus the existing goodwill here of $100,000, we have a net carrying value plus the goodwill amount here for $920,000. Okay, now we have to determine if the goodwill is impaired. So we take the estimated fair value of the unit being tested here of $886,000, and we compare that to the net carrying value plus the existing goodwill here of $920,000 that we calculated off our balance sheet here. And then we can see that this net carrying value plus the existing goodwill exceeds the fair value here of the estimated fair value here by $34,000. So that means that the goodwill is impaired. Now to calculate our impairment loss here, we take the estimated fair value of this unit being tested of $886,000 and compare that to the fair value of the net assets here of $820,000. So we have an implied goodwill here of $66,000, since the fair value of the net assets here is less than the estimated fair value here. So we take this implied goodwill here of $66,000 and compare that to the existing goodwill here of $100,000. So you can see the implied goodwill here is less than the existing goodwill here by $34,000. So we have an impairment loss here calculated at $34,000. Now once this goodwill here is written down, it cannot be adjusted any higher. Okay, to record this goodwill loss here, we would reduce our goodwill account here by $34,000. So we start out with $100,000, so our net amount here would be $66,000. And then we'd recognize a loss over here as part of our net income. And that goodwill loss here would be a separate line within the operating section here on the income statement, unless it's identified with a discontinued operation. In this case, it would be part of a gain loss here on the disposal.